Hello, everyone. While we wait for our attendees to join, I want to just thank everybody for joining us today. And today's topic, by the way, first of all, I'll introduce myself, Michael Thompson, the senior wealth advisor here at Copperleaf Financial in Vermont. And our guest today, I'm super excited to have Jared Kizer join us today. And our topic is evidence-driven investing. What is evidence-driven investing? And Jared has agreed to join us today. Jared is calling in from St. Louis. Jared is the head of investment research at Buckingham Wealth Partners, one of our partner firms that we work with very closely. Jared is a chartered financial analyst, has been with Buckingham for almost 20 years and is part of their investment committee and heads up their investment research. Jared has a long connection, a 20-year connection to our friend Larry Swedra, who frequently joins us for these sessions. And Jared is frequently has articles published in the Journal of Indexes, the Journal of Portfolio Management, Morningstar, and USA Today, and has been included on Bloomberg Television. So Jared is an expert for sure. Jared, thank you for joining us today.
Yeah, it's great to be here. Thanks for having me on.
You are welcome. So our topic today is evidence-driven investing. And I thought this was important because I wanted people to understand we obviously have embraced this philosophy. And it's one of those things that I stumbled across a number of years ago, and the light bulb went off for me. And I thought, my gosh, why this makes so much sense. Why would you ever think about investing any other way? But I want to kind of take a step back and let's discover, what the heck does it mean? What do we mean by evidence-based investing? And where did it come from? So can you give us just a primer, just kind of a little overview about what is it, and maybe why have we, the collective why have we embraced this philosophy?
Yeah, happy to. And I had a similar experience as we were talking about to you in terms of light bulb going off in a big way a little bit over 20 years ago. So yeah, it made a lot of sense to me as well. So I think it is an interesting story. Of course, a lot of different ways that you could tackle the question. The way that I think about it is it wasn't that long ago, certainly, let's say before the 70s or 80s, where I think almost everybody, whether you were an individual investor, institutional investor, folks like us who are advising folks, thought, what investing is I go out and I find somebody who knows a lot about markets, who is able to analyze individual stocks or fixed income investments. And I just find somebody that's really well educated, really well smart, give them my money, and it's just going to happen that they're going to be able to outperform the market over time. That was essentially what people thought of as investing forever and ever. And it's very kind of intuitive, seems to make a lot of sense. But as folks started to look at what we think of as the evidence, which that part surprises a lot of folks. I think of things really starting in the 50s and 60s, where you had folks at business schools that are starting to actually try to answer these questions, like, do we see that approach works well? Does it work repeatedly? Does it work consistently? And what they found was, again, still to some folks counterintuitive, is that the evidence showed that a lot of the conventional wisdom just wasn't an accurate depiction of how markets worked and how investors performed within markets. So one of the first big pieces of evidence that has been confirmed just over and over and over again in the published research is that, well, it turns out that even though that sounds like an intuitive approach to investing, that approach, which we think of as traditional active management, actually doesn't work most of the time, meaning investors who employ that approach to this day, by and large, fall short of broad market returns by the amount of, essentially the amount of the costs that they're paying, whatever those forms, those costs would be, which is a whole topic unto itself. So when I think of where did evidence-driven investing start, that was really, to me, one of the first big developments is folks, the academic community at the business schools answering some really fundamental questions with actual published research about how markets actually work. And the really, really big one that kind of started everything was that finding that, it turns out that most of these professional managers don't outperform markets over time. By and large, they underperform. And I'll say one more thing before I hand it back to you. I always say it's not because those folks aren't smart. A lot of those folks who are trying to outperform the market are very, very well educated. It's just that markets are incredibly competitive, and outperforming the market is much, much more difficult than anybody would expect it to be, particularly after you account for costs. So that's, to me, where it really, really started. And in practice, you saw that really start to take off in the 70s with people started looking at that evidence and said, okay, there's a better way to invest that incorporates this evidence, and things have just kind of escalated from there in terms of understanding of an evidence-driven approach.
Yeah, thanks, Jared. I think that's really great, and we'll dig into some of those pieces more in a minute. But it reminds me of, I talk about the light bulb going off for me, because I grew up, and I think most consumers, but even as an advisor in the early years, I grew up sort of believing what I call the Wall Street myth of, the smart broker or analyst in the back office with the visor and his sleeves rolled up, pouring through the financial statements for the companies and uncovering something that nobody else knew, and that active management was really worth a premium, and they were outperforming, and they were delivering results. But it turns out that's a myth, right? It turns out that and I also find this story really fascinating. I've heard some of as I know you have, some of the people who did this early research, and I've heard stories about them, leasing time on these big IBM computers to really collect the data. And it really wasn't until those days when we had computers that allowed academics to do this research and process this data, where this really started to shine a light on what the truth is about investment performance and active management and things like that. Have you heard any of those old stories about how some of those academics did some of that research?
Oh yeah, absolutely. Like if you look at the topic that we're talking about here, which to me is, if you wanted to say, what's the one thing to understand about evidence-driven investing, it's this finding that we're talking about here. There's lots of other things I'm sure we'll talk about, but this is the big one where it all started. And probably the most well-known early paper that was on this particular topic, meaning like a published piece of research, was I think like 1962 or something like that. So to your point, you can imagine like going out and compiling the returns of, say, all the mutual funds that existed up to that point was a very, very tedious, exercise at that point, both from a computer and data collection period. So you had some folks doing some really cool stuff that was also a lot more difficult to do back then than it would be today. So yeah, we're talking back in the early 60s, essentially, where some of the research started here.
Yeah. And it's really mind-blowing when I love this. I actually love the terminology evidence-driven or evidence-based. And I know that the medical world, the healthcare world has really adopted this. Maybe we even lifted the terminology from the medical field. But what the data show is that markets are efficient, right? Can you maybe talk a little bit about kind of one of those initial findings about market efficiency? What does that mean? What do we mean by markets are efficient?
Yeah, so I think a lot of different ways to think about it. I think one of the more intuitive ways to think about it, it's basically that any new piece of information, let's stick with stocks to keep it simple. Any new piece of information that's relevant about a stock, let's say an earnings announcement. Oh, we expected earnings to be this, and they were that, and that hits the news. Markets adjust incredibly quickly to that new information, meaning let's say you heard about, let's say earnings were higher than expected for Ford, Microsoft, pick a company. If you heard about that like 2 weeks after it was announced to the market, well, at that point it's essentially already incorporated. That's the that's the big kind of underlying thing that we're talking about here. One of the reasons markets are so difficult for traditional active managers to beat. There's the cost side, which I've talked a little bit about already, but the real kind of economic reason is markets adjust very rapidly to relevant news. Not to say I'm not in the camp that says they're always perfect in every single instance, but the idea is they're more often than not, they're very accurate, very quick adjustments. And when I think efficient, what does efficiency mean in markets? It means the speed at which markets adjust to relevant news, and typically adjust to it in the right direction, as you would expect. That's the concept. There are, again, other ways to talk about it, but that's, I think, one of the most intuitive ways to think about what does that term mean, for investors.
Yeah. I think of markets as sort of a giant computer, right? It's sort of many thousands or millions even. I don't even know how many transactions go on in a given day, but I know it's a vast number. And it really is a giant computer processing all the available data. And for somebody to uncover something that the rest of the market or that others don't know, and act on it quickly enough is almost impossible, right?
Very difficult. Yeah, like an example that I like to give folks, Larry may have used this in the past. I think another great example of just how competitive financial markets are. Again, let's stick with our stock market example. Is if you look at today, almost every bit of the trading is done by some institutional investor, meaning, it used to be the case that, again, let's say 30, 40 years ago, where a lot of the trading was being done by individual investors directly. So another thing that to keep in mind for those folks that can get overconfident is when you're out there trading and you're saying you're taking, trading some stock, more often than not, you're trading against an institutional investor, somebody who, in theory at least, is as well equipped as anyone to understand what's going on in markets. So that's another kind of angle of this kind of efficiency thing that we're talking about here, is realizing most of the dollars that are traded every day are essentially traded by super well-educated, knowledgeable of financial markets, institutional investors.
Yeah, and what I always have to remind people of is with every buyer, there's a seller on the other side of that trade, and you have to ask yourself, why are they selling this thing if I want to buy it, right?
Right, exactly.
Yeah, what do they know that I don't know? Probably a lot.
Yeah.
Yeah. So one of the primary tenets, or I think of it as sort of the 5 pillars of evidence-driven investing, is this first concept that markets are highly efficient, and that to think that we can, certainly people have great ideas, and there are lots of smart people out there, but to be able to really outsmart the institutional investors, as you put it, and the market in general, is just really difficult to start with. One of the other tenets or pillars of evidence-based investing, evidence-driven investing, Jared, I think is something that we talk about as risk and expected reward are related. Well, what does that mean? Can you talk about that a little bit?
Yeah, I think let's stick with our stock market example here, but just talk about the totality of the market, say the entire U.S. market. A great example answer to your question is the notion that, say, you're investing in the stock market. You look at all the investors who are investing in the stock market. Everybody knows at this point, or most everybody knows, that's a risky proposition. We can have years like last year, where earnings disappoint. We can have things that probably few of us expected, an onset of a pandemic back in 2020 that had a massive health and economic implications. So people know that, hey, over time, the stock market tends to do well, but it's also, there are going to be periods where it doesn't. And they price the stock market to provide a reward over time. It's not, of course, guaranteed, but expected reward, to use your term, because of the substantial amount of risk that's there. So that's one reason why you tend to see over most longer periods, say, the broad stock market tends to outperform safer fixed income, because investors price stocks low enough on average that they'll provide that expected reward there. So that's the concept there, that risk and expected reward are certainly related in markets, meaning if you're going to try to achieve that higher expected reward, you're going to be more exposed to bad things happening in the broader economy that would impact financial markets.
Yeah, and in a simple way, I think about it as, what can I get for a return or for a yield even on a risk-free asset or a relatively risk-free asset. For example, I know today, we for a lot of our clients will use money markets that are paying 3.5% or even up to 4% today, and it seems like there's very little risk in that kind of yield on a money market account or in a treasury. If I bought a U.S. government bond, a treasury bond or a treasury note, and the U.S. government's paying me 3.5% maybe on a guaranteed basis, backed by the full faith and credit of the U.S. government. If I expect a greater return than that, I should expect that I'm going to have to take some risk, right? I think that's sort of the basic concept. So if I'm going to invest in real estate, or if I'm going to invest in stocks, or I'm going to invest in gold or cryptocurrency or whatever it is, I know that I'm going to be taking more risk, that there's a risk that I could lose, and in return, in exchange for that additional risk, I expect a better return than what I would get on that risk-free asset over time. But over time, I think is kind of the trick there, right? Because it doesn't happen every year, and with that risk, we have to expect some ups and downs.
Yeah, I think over time is important. The other thing I would add there is that we're big believers, of course, that you're going to have to experience that risk over time. Meaning it's a fallacy to think that you're going to be able to figure out, oh, when's the risk going to show up, and now I'll be out and back in after the risk has shown up. To get that expected reward, to your point, you do have to basically be there, day in and day out, and experience both the ups and the downs over time, and not try to think that you can anticipate when the downs are going to be in advance and try to time that in any way.
Yeah, I think the other thing, correct me if I'm wrong, but I think part of the other research that's related to this has to do with the way different types of assets perform, and that some assets may be riskier than other assets, and for riskier assets, we would naturally expect a higher return over time. Can you talk to us about any data that supports that? Is that the kind of data that we use in constructing our portfolios, and how do we go about that? How do we think about that? I'm thinking in terms of, I think there have academics uncovered any differences between how large companies perform versus small companies, for example?
Yeah, so that's one good example. So, for example, I think most people would say, if you looked at publicly traded companies and you said, let's talk about some of the larger names that we would all kind of commonly know for lots of different reasons, and ask yourself the question, would I expect those, they're still risky, but would I expect those stocks are generally going to be safer companies than the smaller companies that most of us have rarely heard of? If you started to tick off the names, you'd say, probably those smaller companies seem to be riskier, seem to be more exposed to economic risks, and I'd expect to see that over time they have outperformed larger company stocks, and that tends to be exactly what you see. Again, to what you noted earlier, that doesn't mean that occurs every single year, but over time, over the longer term, you have seen those smaller company stocks, particularly smaller cap, what we would call more value-oriented stocks, generate higher returns than the overall market. And we think a lot of that is the fact that they are riskier investments, even in a diversified way, riskier than the larger companies that are out there in the market. So yeah, that particular one is one of the most heavily studied things within the stock market, is this difference in return between smaller companies compared to larger companies.
Yeah, and I always tell our clients when we're talking about this idea that, if I'm if I have a certain amount of money and I'm really committed to investing in a food in the food industry, and I started my career in the food industry before I got into this, but and we wanted to invest in a hamburger company, right? And we could invest in a large established company, maybe McDonald's, whether I like McDonald's or not, but that's a fairly large established company. And if I think about my investment dollars, maybe I want to invest $1,000. I think of myself, what are the chances that that company is going to go completely out of business and I'm going to lose 100% of my investment, versus on the other hand, my brother-in-law wants to open a hamburger shop, a local hamburger shop, right? And I love my brother-in-law, but the data on startups and restaurants is pretty risky. That might, if I invest $1,000 with him, I might be thinking about, okay, am I ready to kiss that money goodbye in case it doesn't work out? So there's a risk and reward trade-off that we think about, and kind of how I think about the difference between, in a very sort of oversimplified way, the difference between large companies and small companies. But to your point, the academic research supports that a lot, right? There's been a tremendous amount of research that really demonstrates the characteristics of large companies versus small companies, and even breaking down that further, large what we call growth companies versus value companies. Isn't that right? Isn't this is a highly studied area, right?
It is, yeah. So within like looking at the stock market, yeah, one of the other big areas of research over time has been, do we see that certain types of stocks, to use your term, stocks with certain characteristics generate higher returns than the overall market, or higher returns than some other set of stocks? We've talked about the small cap versus large, value versus growth would be another one, where all that those terms mean are growth stocks, or the stocks that are tending to grow their earnings more quickly. You could think about them as basically more successful as businesses. But it turns out that there's, I think, a good argument that because they tend to be faster growing companies, in a lot of ways, they do tend to be less risky. And you see those growth stocks, a lot of people would think those would be the highest returning stocks over time. They actually tend to be some of the lower performing groups of stocks within the market. So yeah, one of the huge areas of research for a long time within the academic world at this point is, do we see that stocks with certain types of characteristics outperform others? And you do see good evidence in the small cap versus large company dimension, and then this value versus growth dimension. I'll throw out one other one. We get asked a lot about where there's not good evidence, but it's one of those that people might think there would be evidence here, is you don't really see a lot of evidence that particular sectors or industries mechanically generate better returns than others over, we'll get asked for whatever about energy or healthcare. So you tend to see that the sector piece doesn't tend to be a big determinant of long run return. It's some of these other characteristics, like the size of the company, how quickly their earnings are growing. Some of these other areas are what folks have found from a research perspective.
I'm so glad you brought that up, because we frequently have clients, and I think, I blame the financial journalism world, right, the CNBCs of the world, for really promulgating this myth that these sectors are so important, and oh my gosh, it's time to be investing in healthcare, or it's time to be investing in energy stocks or whatever. But I'm so glad you pointed out, because I try to talk to clients about this, that we're going to get our heart broken if we're trying to rely on those industry factors, that there is no evidence that really supports we can consistently outperform from those industry sector perspectives, and it gets us back to sort of the speculating mode, right? The individual stock picking mode. That's really where we're going there, because we're assuming that we can speculate, that we have a crystal ball that's clearer than someone else's, that sector it's time for them to outperform. But thanks for pointing that out. The evidence doesn't show that that's the case, right?
Doesn't show it, and I completely agree on the financial journalism point. That just because people know that a lot of folks think about things in the sector way, so it's a natural thing to kind of then purport within the news. But yeah, if you look at the research side, not a big factor. Now, again, where it is enticing from an investor point of view or from a financial journalism point of view is that's not to say that we won't have periods where a particular industry for quite a long period of time does either extremely well or extremely poorly. But over the super long term, the horizons that should matter for investors, you'll tend to see those things happen unpredictably, but tend to kind of wash out over the longer term, even though they can generate a lot of headlines in the shorter term. Like, for example, how much we both know how much press tech was getting in the late 2010s, 18, 19, and 20, where tech was getting so much of the financial reporting because it was doing really well, and then it wasn't. So yeah, that's very, very tempting to get to be allured into the sector piece being a really important long-term consideration, but it's really not when you look at the research on that particular question.
And it's also, and as you point out, Jared, that also brings up the question of timing, because if you're going to rely on that, then you've also got to be right coming in and going out. Right. Yep. You've got to hit your timing right. And that's, maybe some people do it, but there's no evidence to support it. And your chances of being right coming in and going out are really, really slim. Right.
Absolutely.
What about profitability? Do profits matter if companies is there any evidence to show that profitable companies do better than unprofitable companies? I would think logically that would be the case, but logic doesn't always apply to these things.
Yeah. This is one of those cases where the logic does appear to apply. So we've talked about, again, this whole question of what are the stock characteristics that tend to matter over the long term, the areas that you should focus on. We've talked about two that the research supports, let's say size and then value versus growth. One, in the case of industries, that doesn't really seem to matter over the long term. But this profitability one is one of the newer areas of research that does have good support, in the sense that companies that tend to be the most profitable companies over time have tended to earn higher returns than the least profitable companies. And this is one of those I don't think we know have great explanations as to the why there, but there's very clear in terms of a lot of research done on this, confirmed across lots of different countries, and it's a robust thing that's been discovered in the research. And we're now to a point in my kind of wonky world where folks are trying to quibble over, well, what's the underlying mechanism here, what's going on? But no doubt in the data, you do tend to see that those most profitable companies do tend to generate higher long-term returns than the least profitable companies. And again, this is one, as you noted, there's a lot of intuition there, but intuition doesn't always translate, as you also said. This is one of those where the intuition that just a layperson would have does jive with what we actually see in the data out there.
And so when we as professionals look at this evidence, we look at the research, one of the things that I think is important, and I want you to comment on this, is we probably want to make sure that the data shows up not in just one place, or not just in the US, for example, but we probably want to make sure that it shows up across the board. It shows up maybe in other countries, whether it's developed countries or emerging markets, and things like that. So what do we look for if we're looking for evidence, if we're looking for, these factors, we'll call them, what do we want to see in terms of their consistency or their characteristics in order for us to feel comfortable applying them to client portfolios?
Yeah, really good question. Really important one. Again, something that folks maybe outside of our world don't realize. We've talked a lot about the research, but I think it's still kind of almost bewildering to think about the quantity of research that's being done, that it relates to my answer here, meaning there are just tons and tons of published research on financial markets. I'm sure the quantity of research is still behind the amount of research that's done, say, in the medical field, or at least I would hope it is. But it's still, nevertheless, a large number of folks are doing research on financial markets. So I think, to your point, we would say, and I've been around this long enough to know that research is therefore, we think, incredibly valuable, but you do have to approach it with, I would say, a little bit of skepticism, which relates to your thing, meaning, okay, somebody finds something. Well, first thing that we'd like to see is what you mentioned, which is, well, do we see that this has happened outside of the US stock market? Has it also happened in, say, the UK stock market, or Germany stock market, or Japan? They find that, this is one example, if they find that same result across all those different markets, that's saying, okay, there's potentially something here because it's been confirmed, elsewhere, or confirmed in different periods. I think a great analogy here would be to go back to some of the medical examples that we've used. Let's say somebody's testing a medical technology or a drug or whatever the case would be. They're going to test it initially on some cohort of people, certain age groups. Then they're going to hopefully test it on another cohort. And they're going to see, over time, do we see kind of similar things happening across all these different ways that we have tested this? And the more they see that, the more confident they're going to say, okay, this is really doing what we thought it was doing. Similar thing needs to happen in financial market research too. So we're looking for, is it pervasive across all the different regions of the world, since there are lots of different stock markets that exist, and you can look at this point from a research perspective. Did it work in not only the original time period that they used in the study, but did it work in other separate time periods? That's another great example. And then I think that the part that ideally you want to be there, but can be more challenging, is there some intuition here as to what we're seeing? And I think that's important as well. Like, is there good economic intuition? And that one, I'll be the first to admit, can be a challenging area, but I think there are some where there is good intuition, like our small company versus large company example, or even potentially the profitability example. That's another thing to think about. Does this make sense, or is this just some, like, I think the example, I'll probably botch it, is the, butter prices in, I don't know, Bangladesh being correlated with when the US market does poorly. There's some crazy examples like that are actually there in the data, where you'd say, well, maybe they're in the data, but what possible reason would there be for this being a viable, relationship there? And it sounds funny, and that is a funny example, but you have to be cautious with the research side, because there's so many people researching markets at this point, that there are going to be things that they find that don't end up, being useful on a go forward basis. So definitely something to think about when you're in the world that I live in.
Yeah, and I'm glad that you talked about that, because for us to be able to apply it with help from your research and the research from Buckingham and some of our other partners, we want to see that. We want to see that it is robust, that it's pervasive, and that it makes sense, that it's logical. There's some apparent reason that we can explain that makes it happen. And the truth is, there probably aren't a lot of those factors with all the research that's coming out. I think that's being, you guys and some of our other partners at Dimensional and others in the academic world certainly are really taking a hard look at that research and seeing, do these things apply? Are there things that we can use? Have they passed that acid test, I call it, to allow us to feel comfortable applying it to client portfolios? So I think that's really important. I think one of the other pillars, Jared, might be diversification, right? And I think diversification is something that can be a bit of a misnomer. Some people, what the heck do we mean by diversification? But well, maybe I'll throw that at you. Is diversification one of those factors that we would think about that's really driving our evidence-driven approach? Is it important? And what do we mean by diversification?
Yeah. So first point, yeah, it's absolutely, I think, crucial. I like to think of it as lots of folks do, like the short quip is it's the basically one of the only free lunches in investing that we all get to participate in. It's a very logical thing to do. And it is super important. You've hit on some examples leading up to now, like let's open up a private burger shop, idea. You pointed out that, well, doing that on a standalone basis is a very, very risky proposition. And to take that example, if you're going to do that, let's buy all the companies that are in that food service business so that we're diversifying some of those individual risks. So it is an absolutely crucial thing, but also there's a good bit of nuance to it because there are a lot of different ways to think about it. I think the first thing to think about is, of course, most of the clients that we work with are going to have some fraction of their assets invested in the global stock market, let's say. So out of the gate, I would say the first instance of diversification is you want to own as many of those publicly traded stocks as possible so that the only primary risk you have left is the kind of the global economic risk and not the risk that you pointed out of this single company, going bankrupt or this sector struggling. If you own all the companies, there's still risk there to be sure, as we saw again last year in many other cases, but there's a lot less risk there than there would be if you were only owning a handful of those companies or only owning companies in a certain industry. So I think that's the first principle of diversification, is that you want to be very, very diversified by both a large number of individual stocks that you hold, a large number of sectors that you hold, ideally a large number of different countries that you have exposure to, because those are the free lunches of investing. That's what diversification, I think, means in a lot of ways. I think a related topic that you can call us, is this diversification, is this risk management? I don't think we need to quibble over semantics, but I think it's fair to use diversification and saying, okay, if I don't want to have all my wealth invested in the stock market, let's say I'm heading toward retirement or in retirement, what are the sources of diversification / risk management that I can use to offset those stock market risks? Again, the obvious one being having some portion of the portfolio invested in safer fixed income oriented investments can provide some diversification there. So yeah, diversification is absolutely a fundamental tenet finding of evidence-based investing, evidence-driven investing. A lot of different ways to think about it. I think those are some of the ones that come to my mind, with, again, to me, the most fundamental being own lots and lots of individual stocks and don't concentrate your stock investments in a handful of individual companies or a particular sector or industry.
Yeah, and I always say to people, if we can own the market and take the returns that the market gives us, let's take the return of the market rather than risking speculating on a single company or a single sector, even, for example. Why wouldn't we want to do that? And so the flip side of that coin a little bit is, could we be giving up return by doing that? Isn't it true that there's some fantastic, unbelievable returns that people often receive from concentrating their bets in individual companies and individual companies outperforming? So why wouldn't we want to do that? Why wouldn't we want to kind of roll the dice and try to get that higher return if it's available from the last few years we saw Tesla just, my gosh, quadruple digit returns. Holy cow, wouldn't anybody want that?
Right. Yeah, a lot of good layers to talk about there. The first one that comes to mind, if you said, well, what are the ways to generate huge amounts of wealth? Well, one of the ways is, say, owning an individual business, a startup business. So that can be a way to generate wealth, but it's also, again, keep going back to your burger example, it's also very, very risky and a way to lose lots of wealth. So you'll absolutely see people that have great business ideas that turn those business ideas into fabulous amounts of wealth. The first answer to your question would be that's a very vital part of the economy, can be a great thing to do, but probably everybody gets to a point where after that has happened, if they've been fortunate to generate that amount of wealth, where continuing to be that undiversified is not a substantial approach. Like the again quip that I like to use there is the way to get fabulously wealthy in terms of generating wealth is oftentimes a lot different than the ways that you would go about preserving that wealth. So I think that's the first thing that would come to mind there. When you venture into the public stock markets, I get a lot more kind of rigid in the way that I think about that question. I think it's kind of back to where we originally started the conversation today. In publicly traded stocks, finding the handful of stocks that will do extraordinarily better than the market. If you can do it, great. I'm being sarcastic here because it's incredibly difficult to do consistently. Again, that's kind of the synopsis of everything that we're talking about today. So while that sounds great, let's try to pick the next high flying publicly traded stock. It's incredibly difficult to do. And other thing, I don't have the actual examples at the ready, but a lot of times you'll find that the absolute highest performing stocks are frequently companies that you've not heard of or never would have guessed were the best performing companies. So it's incredibly difficult to do. And if you could do it, you're right, you would generate astronomical returns. But the safer approach is once you've generated that wealth, to be broadly diversified and not take those concentrated risks. And last kind of stat that I'll throw out here, which shocks even somebody like me that kind of lives this stuff day in and day out. If you looked at the entire history of the US market, every individual stock that's ever traded in that market, the most common inception to life of that stock return is minus 100%. Meaning the vast majority of publicly traded stocks that have existed in the history of the US market eventually lost everything. And that sounds like, how can that possibly be true? But it shows even in the publicly traded markets how dynamic markets are and how infrequently an individual company is able to be a viable entity for decades upon decades upon decades. More often than not, most publicly traded companies at some point will end up losing all of their value, which is just another, I think, fabulous stat to try to get some sense of just how risky individual companies are, not even using your startup example, but just looking at even publicly traded stocks. It's a very, very risky, proposition, and diversification is definitely, I think, the best approach for certain once you've generated that wealth. I think diversification is the right approach.
Yeah. And, it's, you bring up a great point. It's fascinating to look back at the history. If you look, and there are, we've both seen papers and articles and things. If you look back over the decades of the top performing companies, sort of decade by decade, it's amazing. Those, the old well-known names that we might not even recognize today, but the dominant companies of those decades or those years rarely persist, and so many of them are gone, have sort of gone the way of the way of Polaroid or right. Kodak.
Polaroid's a great example, but there are lots of others there too. But yeah, that stat is a true and a good one, but also startling when you think about it. Even that is beyond what I would have ever guessed, that most commonly every company, eventually loses all of its wealth, or more commonly than not. You just don't see that viability, that persistence over multi decades is a rare phenomenon for an individual company.
And it's also back to that sort of Wall Street myth. I think Wall Street has done a really good job of sort of perpetuating the myth of the brilliant stock picker and the active manager. But back to our evidence, I believe, correct me if I'm wrong, but I think there's ongoing research every year that looks at and surveys the universe of actively managed portfolios, and consistently provides some evidence of how many of those active managers actually do outperform. And those numbers tend to be kind of shocking too, don't they? And my question would be, and then I would ask, do they persist? Do those, if active managers do outperform their broader market, can we rely on that? Do they hang in there? What do you know about that research? Am I wrong? Was that kind of a one and done study, or is that ongoing stuff?
No, you're spot on there. Yeah, there is ongoing research there. I think Standard and Poor's, the company behind the S&P 500, is I think the main researcher that I'm aware of, and the way that I like to think about it is the primary reason they're basically the only group still doing this research is that the academics got tired of getting the same answer over and over again. So the academic studies got to a point where saying we've found the same thing over 100 times. This is not a new research finding. So thankfully, we've got Standard and Poor's has kind of kept up a lot of that research. And yeah, so they've got a great study they publish 2 times per year. It's called the indexing versus active scorecard that has gotten a fair bit of notoriety. It wasn't that well known like 15 years ago, but you'll see Wall Street Journal, others report on it twice per year when they release the study. And they find exactly what you pointed out, which is if they'll basically look at every actively managed fund that exists, compare it to its benchmark over multiple periods of time, say over the last year, 3 years, 5 years, out to 10 years. And they find, particularly when you look at those longer term horizons, that most commonly it's something like only 1 in 5 funds outperforming their benchmark net of expenses at, say, over a typical 5-year period or 10-year period. So we're talking like 4 in 5, sometimes even higher, when they release those studies, are underperforming their benchmark. And you mentioned the other point that sometimes I'll get asked when I'm talking about that. Well, what about the 1? What about the 1 in the 5? Is that not the manager that we should be focused on? Well, again, it's one of those things that sounds kind of intuitive, but when you say your persistence question, do we see that same manager repeat that in the next 5-year period? Rarely is that the case. So meaning there's just not, even if you're able to identify those managers who did well in the past, but you then ask the question of do they tend to do well in the future, the answer is more often not than no, there's not persistence there. So it's very, very difficult to identify those skilled managers to the extent that they're out there.
And if you like math, what I find fascinating is those numbers tend to look very similar to the numbers that you would expect from a random coin toss.
Yeah.
So is it skill or is it luck when they happen to outperform? We don't know. We don't have any way of telling, right?
Yeah, it's a great. Yeah, I wasn't gonna tax our audience with probability today, but yeah, that's the example. And I'm talking. That's been asked. That exact question has been asked by a lot of the researchers. Like this, is this kind of a random occurrence thing, like a coin flipping thing? And that's unfortunately, I hate to say it because these people have jobs, but it doesn't look that much differently from kind of a coin flipping exercise. So even those ones that you identify, you rarely can answer the skill versus luck question is kind of a huge problem that you run into.
Yeah. So when we think about kind of rewinding a little bit, when we think about, what are the pillars of evidence-driven investing, and what are the things that we rely on? We know that markets are efficient. Kind of the earliest research started, showed that really markets are efficient. It's really hard to kind of outperform them. That risk and reward are related. That we can really identify the behaviors of certain factors, certain parts of the market, and certain types of stocks or bonds. We can kind of group them together if we do the research, and they tend to perform in a similar fashion. And if we can continue to refine that research, we can identify there are a limited number, but a few areas that we can identify that consistently show these behaviors, that maybe we can apply those behaviors to portfolios, and that diversification is really important. Let's take the returns that markets offer us. Let's try to eliminate speculation from our investing, and as you say, take advantage of the only free lunch on Wall Street, which is diversification. Those are 3 essential things that we can apply to our portfolios and use that science to really build out a portfolio. And then there's this question of indexing versus what I think of as sort of passive investing or asset class or evidence based investing. And I think there's some important differences there too, because over the last couple of decades, Vanguard and a few others have gotten really big, frankly, and gained a lot of notoriety for identifying indexing and basically saying, okay, if we're going to take the returns that markets give us, let's just pick an index and let's just invest in the index. But we may be able to think beyond that a little bit, right? How do you think about using indexes, and what do indexes fit into all this, or an index approach to investing? How does that fit in?
Yeah. So I think indexing, to its credit, is kind of practically where everything so there was a lot of this academic research that was done, say, over the 50s and 60s, a lot of these basic findings. I think you did a great job of summarizing, let's call it the top 3-4 tenets of an evidence-driven approach. And then that practically turned into investment solutions, let's say starting in the 70s, and things have kind of gone from there. So the first kind of index funds came online in the 70s. So to its credit, that approach was kind of the initial embodiment of everything that we're talking about here, of the embodiment of the academic research. And as good as it is, I think there are, particularly in certain asset classes, where there are potential improvements on a pure indexing approach. Like, let's go back to our small cap example. Let's say you say that, yeah, the research shows that small company stocks over time, particularly small cap value, tend to do better than the overall market. Let's say it's mostly risk, so I want to have a portion of my portfolio allocated to a small cap value fund. I think that's a perfect example of an asset class where a pure indexing approach is certainly infinitely better than a traditional active approach to that asset class. But I think there are, let's say an enhanced index approach. A lot of people use different terms that can improve upon that in certain ways. So, for example, one potential negative that you see with indexing is a lot of those indexes will have kind of mechanical rebalancing approaches, where there's a particular day in the year where any stocks that are no longer small cap have to exit the index. Sensible at some level. That creates some frictions in the marketplace. I think it's one of the reasons that there are some costs, some returns that are lost as part of that rebalancing process. So I think ideally for a lot of these asset classes, more of an enhanced index approach, where the manager is not using a third-party index. They're kind of constructing their own way to buy the totality of that asset class without the mechanical nature that most pure indexes would employ. So I think there are advantages there, particularly in some of the smaller company stocks, some of these more nuanced portions of the market that we're talking about today, where more of that approach does have some benefits relative to a pure indexing approach.
Mm-hmm. Yeah, the reconstituting is one that always gets me, and we always see in the S&P 500, for example. We always see that the big news, the big headlines, X company is coming out of the S&P 500 and this company is going into the S&P 500, and these poor index managers, and it's not just machines or computers that are running them, but individuals are tasked with kind of keeping those portfolios together. They've got to wait, even though the announcement's already been made that company X is coming out and company Y is going in. They've got to wait until that day, that reconstitution day, to trade and bring the old company out and the new company in. In the meantime, what's the market done? The market's sort of bid up the price of the one that's going in and bid down the price of the one that's going out. And there's an inherent disadvantage and inefficiency there. And that can be somewhat meaningful, I think, to the index.
Yeah, I agree. We spent a good bit of time, I think rightly, kind of bashing active management to some degree, but this is an example of active managers trying to use that information against the pure indexing strategies. And there is good data suggesting that in general, it's called front running in our world, kind of front running the index trades has hurt some of those indexes over time in some ways. So that's again example of people trying to use that information to garner an edge in the marketplace.
The other thing I think about it, and I think you hit on this a little bit when you talked about sort of a private approach to thinking about an asset class versus an index, is Another thing which bugs me a little bit, frankly, I think about the S&P 500 and the way that index is constructed as a, it's weighted a certain way. It's not, you would think that if it's 500 stocks, they would all be equal. You would have, this the same amount of each of those 500, but it's not exactly constructed that way generally, is it? How do we think about that, and might that influence the way that we build a portfolio if we're trying to include a certain part of the market?
Yeah, so the S&P is technically, S&P 500 is technically managed by a committee. So there are some folks that have accused, well, is the S&P 500 an active approach because there's a committee? It's not, we're calling it an index, but it's an index essentially where technically the names are chosen by a committee. I think the superior approaches that are more in the spirit of everything that we've talked about today are where you got essentially kind of more hard and fast rules as to how the asset class is managed. Say we're going to buy every stock that's smaller than the 1,000th company in the market, or an example like that, where you're building kind of rules that are truly rules and there's no human element substantially in the process other than developing the rules, but the rules are to target an asset class where there's lots of evidence in support of it. I think those types of approaches are better, but also combined with approaches where you're not basically telegraphing to the entire marketplace exactly what you're going to do and when you're going to do it. So there is some skill, I think, here to, particularly for some of these, again, I keep saying more nuanced asset classes in terms of how you're building those asset class strategies. I think there are some things that you need to take into account there, and some examples here in your S&P 500 example where it's an index at some level, but also there's kind of a committee, structure in place there that not a lot of people realize.
Well, and the thing that we've seen, and that investors have seen so frequently over the last few years, is when they think about, the S&P 500, for example, and I'm just picking on that because it gets under my skin. People feel like it's really diversified, but in fact, it's overwhelmingly influenced by the top, 5 or 10 companies because of the way that index is constructed, right?
Yeah. Right. And it's only the U.S. market too.
And it's only the U.S. Yeah.
No real substantial global diversification component to it.
Yeah. So we've got a few minutes left. I'll remind our participants, if you have a question, please drop them in the chat and we'll be happy to address them. They're really we talked about 5 pillars of evidence-driven investing. The first 3 markets are highly efficient. Number 2, risk and expected rewards are related. Number 3, diversification is essential. The last 2 are pursue factors of returns, and we talked a little bit about factors, and focus on what you can control. In the time that we have left, Jared, what would you say about those kind of final 2 pillars? Anything to add about them?
So I think more on the last one than the first one. The first one we kind of talked about, because factors, again, it's basically characteristics, like what characteristics matter within the market, which I know we've talked a lot about what the research has to show there. Again, recap is small versus large, value versus growth, and higher profitability versus lower are some of the key characteristics that seem to matter to stock portfolios. But I think the last one is a super important one to spend maybe our closing minutes here. So some of the things that I think about there, again, they have connection to some of the topics that we've already talked about, but things that come to mind there are developing a sensible allocation and sticking with it. So once you figure out, relative to the goals that you're trying to achieve, what's the allocation that makes sense? Let's assume that it's highly diversified, so you've checked that box. But I think you also need to be prepared, and evidence certainly validates this, to basically stick with that allocation through the ups and the downs. Really the only factors that, to this point of control, what you can control, I think that should have a big impact on changes would most typically be a change in goals. Mm-hmm. So I think just the sticking with it aspect is a big part of the control, what you can control. I think there's a big kind of planning and tax element that I always think about there. You want to have portfolios where you're trying to keep down as many of the costs as possible. and certainly trying to have that portfolio that you adopt be as tax efficient as it can be, meaning where you're not losing any more return to taxes than you have to is a key consideration there. So yeah, there's a whole host of practical things that I think fall into that fifth bucket, like management of taxes and kind of sticking, with your allocation through the ups and the downs are two that immediately come to mind there in the control what you can control category.
And I always think, thanks for that, Jared. I always think of it as really one of the fundamentals for us, which is have a plan. Have a plan and design your portfolio around your plan, meaning every client, like every institution, should have an investment policy. And we need to determine, how hard does your money need to work to accomplish your goals? And let's construct an investment policy that supports that objective and stick with it, right? Those are pretty fundamental and pretty simple, but that's the lion's share of the work that I think we do with our clients in order to apply the other four. So I think you're right that final factor is probably the most important overall. Well, we've reached the end of our time, Jared. I want to thank you so much for joining us. It's been a lot of fun chatting with you. I hope you'll be able to join us in the future for another conversation. For those folks that are listening today, I invite you to join us in February, where we're going to be doing a look at what's happening in sustainable investing and what are the last 5 years shown us, and what do we see going on in the future around sustainable investing. My guest will be Sam Adams and his wife Sarah, and we're going to be doing a deep dive into kind of what's the current state of sustainable investing. So thanks everybody for joining us. If you have questions after this, please email us. This session is recorded and we're going to post it on our website within a week or so. And hope everybody has a fabulous week moving forward. And Jared, thanks again for joining us.
Yeah, thanks again, Michael. Enjoyed it.